it's only a 5-7% correction after such a big run. And the run has been stupendous in the market, given where valuations are. Even allowing for the fact that a new earnings cycle might be beginning, would you expect this correction to deepen? Because even strong bull markets take in at least 10%, sometimes even 20% running corrections. What do you think this one could be like?
So you're right, Udayan, for us to go to 10% is another 3-4%. And I would say that would be our sort of a guess that maybe 3-4% left as far as the markets are concerned. Actually, if you go in the broader markets, stocks have corrected anywhere between 10 to even 25%. So the correction is not very visible from the headline Nifty. Actually, if you go deep down, stocks have corrected 10 to 25%, and that's not a very pleasant thing to see if you have stocks which have corrected so sharply in your portfolio. Our view is that there are a confluence of factors on the positive side. Obviously, as you rightly said, earnings growth looks phenomenal. Next 2 years, FY22 and FY23 put together would see a 50% increase in profit compared to FY21. Valuations are not cheap, but they are not exorbitantly expensive. I think come January, February 2022, we'll all start to talk about financial year 24. And on that basis, we are like at 18.5 times. And it's 15% higher than the long-term trend, but it's not like completely out of whack. And then given the fact that at least our view is that liquidity is going to continue, and you also have a confluence of both private capex as well as the government capex coming in, I think we're getting into a good situation where GDP growth can surprise on the upside for the next 2-3 years. What we also have to not forget is that traditionally, the November to February, March period is a good period as far as rebalancing of FI, allocations are concerned. And at least, my interaction with friends overseas point that India might be gaining in terms of allocations at the expense of maybe China in this round. And therefore, on this correction, our view is that smart, institutional inflows should start to come in. We are also heading into a phenomena or a phase where government is on an overdrive in terms of privatization, in terms of getting the economy back on track. We have the union budget coming in January, and traditionally there also is a rally preceding the budget. So I think both on the fundamental and technical factors, our view would be that max maybe another 3-4% to go, and then we should start to see some semblance of stability coming in.
Sunil, what else is exciting you in terms of a longer-term horizon? We've seen IT companies outperform and continue to surprise on the upside. Is that a trend that you're continuing to capitalize on? Are you investing or looking at allocating more when it comes to that bucket in the market?
So one is, we are lucky to be investing in India, and we've been eternal India bulls, and it's helped. Being positive on India has helped. And I think next 3-4 years, we again see a good sort of a cycle of growth led by lower interest rates. And obviously, generally, companies doing quite well. I would agree with you on the IT services / digital front. Digital as a segment is awesome. There is no doubt about it. Our own individual habits of using digital for everything we do is there for everyone to see. The only problem has been the valuations. And if we get an opportunity, maybe this meltdown in some of the digital plays would allow us to invest in future IPOs of good digital companies, maybe at a decent valuation. That would be a great opportunity. Maybe some of the listed plays might give us a reaction and allow us to invest. I think digital as a theme cannot be ignored. IT services, again, there has been meaningful correction of almost 15-20% in a lot of companies. Maybe a little bit more correction. I think IT services company, Indian IT services company are globally competitive. There is this huge move globally towards moving into digitization from all corporates, and I think we are already seeing demand, being very robust. Some of the other segments where we are quite positive are homegrown brands. We are seeing consumption coming back all over the country, particularly in tier 2, tier 3 towns and smaller cities. We are seeing a phase where after 2 years, entire country is opening up. We saw how during the festive season demand has shot up. In the next 6 months, I have heard that there are a record number of weddings. When we see our own circle, no one celebrated their anniversaries and birthdays and so on and so forth. They're all going to come back. So I think the next 6-8 months, discretionary consumption should do very well. At the same time, we have to remember that there are two pockets of discretionary consumption. One is the very obvious names which are trading at 80-90p. I think those are not something which we are looking at. But at the same time, there are, as I said, the second-tier brands which are focused more on towns and smaller cities. I think that is where there is a huge opportunity.